You've analyzed the chart. The technical setup is flawless. You enter a buy order on GBP JPY and set what feels like a perfectly reasonable 30-pip stock loss. Then, you watch as a single 1-minute candle plunges directly through your level, only to immediately reverse course. You were exactly right about the direction. The market roars 150 pips higher, exactly as predicted. But you aren't in the trade. You were stopped out by a fraction of a pip just seconds before the rally began. It feels personal, but your broker isn't actively hunting your stop. What you just experienced is the standard operating procedure of the GBP JPY. Because of high retail interest in this pair, institutional players routinely push the price just past obvious support levels to trigger stop-loss orders. They use your position as exit liquidity to fuel their own massive entries. This chart shows the average daily range, or the typical pip movement in a 24-hour period, of major currency pairs. While the Euro-USD might move a modest 80 pips a day, the GBP-JPY regularly swings between 160 and 200 pips. If you apply the exact same risk parameters to this pair that you use for standard, slower-moving majors, you are mathematically guaranteeing a blown account. For over a decade, trading the British pound against the Japanese yen was a straightforward game. Because the Bank of Japan kept rates anchored near zero, traders simply bought the pair and held it, collecting the interest rate difference in a predictable carry trade. That strategy is now obsolete. The Bank of Japan has officially stepped away from its long-standing negative interest rate policy. When they tweak their yield controls or hint at hikes, the yen doesn't just drift, it snaps with aggressive two-way price action. Meanwhile, the Bank of England is fighting its own fierce battle against persistent domestic inflation, keeping their rates elevated to cool the economy. This creates a constant macroeconomic tug-of-war. Instead of a smooth, one-sided climb, we see violent volatility. When data releases from London and Tokyo collide in the same 48-hour window, the pair can whip 300 pips in a single session. To survive this so-called dragon today, your foundational strategy has to account for this constant, high-level turbulence. If you want to trade this pair, you must be awake when it wakes up. At 8 GMT, the day hits the London Open. At this exact hour, the Asian trading session concludes, just as massive institutional volume pours in from UK banks. This overlap creates an enormous liquidity injection that frequently sparks 100-pip breakouts. But the opening hour is chaotic, often producing fake-out moves to grab liquidity before reversing. To determine the actual direction of the breakout, you need a compass. Watch global equity indices like the S&P 500 and the Nikkei 225. GBP-JPY is highly sensitive to global risk sentiment. If the S&P 500 is rallying and the Nikkei closes in the green, investors are in a risk-on mood. They will sell the safe haven yen to buy higher-yielding assets, signaling that you should prioritize long breakout positions. By combining the strict timing of the 08 GMT liquidity surge with the broader risk sentiment of the stock market, you position yourself alongside institutional momentum, rather than getting crushed by it. Getting the direction right doesn't matter if your stop-loss is placed blindly. To survive the pair's notorious wicks, you have to throw away arbitrary 30-pip stops and adopt dynamic, mathematical risk placement. This chart illustrates the average true range, or ATR. It measures the absolute distance a market moves over a specific time frame, giving you a real-time mathematical read on how aggressively the asset is currently breathing. You use this ATR to calculate volatility-adjusted position sizing. Because the Dragon moves twice as fast as the Euro, you have to cut your trade size down. By scaling down your volume on high volatility pairs, a 1% risk on GBP-JPY results in the exact same dollar loss as a 1% risk on Euro-USD. Once your size is right, you need to defeat the stop hunt wick itself. Find your technical stop below a recent swing low, and then push it slightly wider using the buffer zone method. Add an extra distance equal to exactly 15% of the current 1-hour ATR. This tiny mathematical gap pushes your exit outside the noise zone. By using ATR to normalize your lot sizes and build out your buffers, you make those aggressive stop hunting wicks completely harmless. Even when you catch the breakout and secure a winning trade, you aren't safe. Managing an open position on this cross requires strict discipline because its trends frequently go vertical and irrational. Mapped against Bollinger Bands, candles stretching the upper boundary show an overextended market. The true exhaustion trigger is the center, when the gap between peak price and the middle moving average exceeds one daily ATR, a severe snapback is probable. Warning tone. Never blindly short an overextended dragon. It can stay irrational longer than your account can stay solvent. Wait for clear technical confirmation, like a bearish engulfing candle on a 15-minute chart, before betting on the reversal. By recognizing these exhaustion parameters, you know precisely when to take your money off the table, protecting your hard-earned profits from being erased by a sudden crash. Trading the GBP JPY in an era without negative interest rates demands a completely new approach. Passive holding is over. Active, volatility-based risk management is the only way forward. If you try to tame this pair using standard risk rules meant for slower markets, you will inevitably be chopped up and wicked out of your positions. You don't have to do the complex math by hand. The FXNX volatility calculator automatically processes current ATR data to compute your position sizes and normalize your risk across any high-range pair. Join thousands of traders on NX1, where you get access to 0.0 pip spreads and institutional-grade execution, essential tools when navigating markets that move this fast. The mechanics of the market have shifted. Adapt your risk parameters to the new macroeconomic reality today, or accept your role as the exit liquidity funding the next 150 pip breakout.